Consolidated statements bring together the financial information of two or more separate legal entities into a single set of statements for the economic entity as a whole. The cost of investment in the subsidiary is not included in the consolidated statement of financial position, as it is eliminated in the pro forma journal entries. Group financial statements should reflect only results of transactions between the group as a whole and third parties. This is because, from a single entity viewpoint, a company cannot hold an investment in itself, and that is essentially the case here, as the parent company and the subsidiary have been joined into one legal entity. This intergroup transactions, such as the cost of investment, are eliminated in the pro forma journal entries in the consolidation process. Thank you.
Goodwill is an asset. Goodwill is an intangible asset that is bought upon acquisition of the subsidiary. So for example, when a parent buys a subsidiary, the parent would normally, as you believe, pay the net asset value of the subsidiary. However, this is often not the case in real life. In real life, the parent often buys a subsidiary at a premium. This premium is often known as the goodwill. The premium is amortized over the useful life, which is estimated at 10 years according to IFRS for SMEs. However, goodwill will only be found on the consolidated financial statements. It will not be found anywhere on the parent's or the subsidiary's individual financial statements. This is because goodwill is only made when an acquisition takes place. However, on the parent's financial statements, as part of investment, a portion of that will be in respect of the goodwill acquired. Cool.
Answering question C of the tutorial, which states that land is shown at a cost of 30 million rand on the subsidiary statement of financial position and shown at a cost of 33,050,000 rand on the consolidated statement of financial position of the group. As it is the same piece of land, why does the amount differ when the group policy is not to revalue land? Though the group policy is to record assets at cost, IFRS Section 3 states that at acquisition date, identifiable assets acquired and liabilities assumed, i.e. the separable assets and liabilities that meet the asset and liability definition and recognition criteria, to be measured at fair value. Fair value being the market value at that date. So the excess 3,050,000 rand is the fair value gain, which will not be recorded on or disclosed on the statement of financial position of both the parent and the subsidiary company, but the pro forma journal entries will be done to record the gain on the group accounts, and they're disclosed on the consolidated financial statements of the group. Thank you.
Now suppose we have Company P, the parent company, and Company S, the subsidiary. Initially, S has 350,000 rand sitting in its bank account, and Company P has not. So, from the group's perspective, the total net asset value is 350,000 rand. Now, when S loans this money to P, it removes it from its bank account and it goes and sits in P's bank account. So P has 350,000 rand sitting in its bank account. And according to IFRS for SMEs, P must recognize a liability loan from subsidiary in its books for 350,000 rand, and S must recognize an asset receivable of 350,000 rand. Notice, from the group's perspective, after taking into account the transaction, the net asset value is 350,000 rand plus 350,000 rand minus 350,000 rand, which gives us 350,000 rand. So there has been no change in the net asset value of the group. What this means then is that the users of the group find that it does not add any value for them to know that the group gave itself a loan, because ultimately their interest hasn't changed. This is why the consolidated financial statements of the group do not show the loan from the subsidiary as a liability.